meteor. In March 2008, Bear Stearns was the fifth largest investment bank in the United States. It had survived the Great Depression, World War II, the savings and loan crisis, the dot-com collapse, and September 11th. It had been in business for 85 years. Then, in roughly 72 hours, it was gone. Not weakened, not restructured in a slow, grinding decline. Gone, sold to JPMorgan Chase for $2 a share, a price that valued the entire firm at less than the building it occupied. The question is not simply what went wrong. The question is how an institution with 8.5 decades of history could disintegrate faster than most companies file a quarterly report. The answer is not one bad decision or one reckless leader. It is a structural story about what Bear Stearns was built on, how that foundation quietly rotted during the years it looked strongest, and why the specific nature of its business made survival nearly impossible once the market turned. Bear Stearns was founded in 1923. It began as an equity trading house, and that heritage never really left the firm's identity. Where competitors like Goldman Sachs or Morgan Stanley built reputations around client relationships and advisory work, Bear cultivated a harder-edged, more transactional culture. It was known as a scrappy shop, leaner than its rivals, intensely focused on trading profits. For decades, that difference was a source of pride. The firm built a particularly strong presence in fixed-income markets, bonds, mortgage-backed securities, and the complex financial instruments that grew out of them. And in the years following the 2001 recession, as the Federal Reserve held interest rates low and American housing prices climbed, fixed income became the most profitable corner of Wall Street. Bear Stearns was positioned directly at the center of it. The model worked for a simple reason. Bear was not just trading mortgage-backed securities, it was deeply embedded in creating them. The firm packaged home loans into bonds, sold those bonds to investors, and collected fees at every step. As housing prices rose, default rates stayed low, and demand for mortgage-backed products seemed insatiable. Revenue followed. The strategy looked not just profitable, but disciplined. By the mid-2000s, Bear Stearns was a firm at full speed. It reported record revenues. Its stock price climbed well above $150 per share at its peak. The firm's headquarters in Midtown Manhattan became a symbol of the modern investment bank, a machine for converting financial complexity into profit. Bear's leadership, particularly longtime chief executive James Cayne, had built something that appeared durable. But durability requires a foundation that holds under stress, and Bear's foundation had a specific and serious flaw. The firm was deeply dependent on short-term borrowing, a practice called overnight repo financing, where a bank pledges its assets as collateral in exchange for cash it needs to operate, and then renews that arrangement every single day. This is not unusual on Wall Street, but it is unusually fragile. When assets hold their value and counterparties trust you, repo financing is cheap and reliable. When counterparties begin to doubt the quality of your collateral or doubt your firm's stability, they stop renewing overnight. And if your entire operating model depends on those daily renewals, you do not get weeks to adjust, you get hours. Bear's collateral was heavily weighted toward mortgage-backed securities and the more complex instruments built on top of them. In the summer of 2007, two Bear Stearns hedge funds that had bet heavily on subprime mortgage instruments collapsed. The losses in those funds were significant, and the firm had to absorb exposure it had hoped would remain off its main balance sheet. More important than the direct financial damage was what the collapse signaled. It told the market that Bear Stearns had real, concentrated exposure to the part of the mortgage market that was beginning to crack. From that point forward, the question that haunted every conversation about Bear was not whether it had losses. Everyone on Wall Street had losses by late 2007. The question was whether its balance sheet was trustworthy enough to support its enormous short-term borrowing needs. That question had no clean answer, because the instruments at the heart of the problem were genuinely difficult to value. And uncertainty in a repo market is nearly as dangerous as confirmed loss. Through late 2007 and into early 2008, Bear's leadership attempted to communicate confidence. The firm was adequately capitalized, officials maintained, its liquidity position was sound. But confidence in a firm that depends on daily counterparty trust is not rebuilt through statements. It is rebuilt through time and through demonstrated stability, neither of which the market was prepared to offer. In early March 2008, rumors began circulating that Bear Stearns was in serious trouble. Whether those rumors were accurate at that precise moment or became accurate because they were believed is one of the genuinely difficult questions in the collapse's history. What is documented is the effect. Counterparties began declining to renew repo agreements. Clients began withdrawing funds. Hedge funds moved their prime brokerage accounts. Each withdrawal made the next one more likely. By March 13, 2008, Bear's liquidity had collapsed to a level that made normal operations impossible. The Federal Reserve and the United States Treasury intervened over that weekend, arranging emergency financing through JPMorgan Chase and ultimately orchestrating a full acquisition. The initial offer was $2 per share. It was later revised to $10 per share, still a fraction of where the stock had traded months before. Bear Stearns ceased to exist as an independent firm in May 2008. The building remained. The brand disappeared. Thousands of employees lost their jobs. Many had held significant portions of their personal savings in company stock, a cultural practice encouraged by the firm's leadership as a demonstration of alignment. Those savings were largely destroyed. David Malpass, who had served as the firm's chief economist from 2002 until the collapse, went on to prominent positions in government and international finance. The broader Bear Stearns workforce scattered across the industry or left it entirely. The intellectual infrastructure of the firm, its trading systems, its client relationships, its people, was absorbed into JPMorgan Chase or dispersed. The collapse of Bear Stearns came 6 months before Lehman Brothers fell, and it reshaped how regulators and central bankers thought about the coming crisis. It demonstrated that a firm could be technically solvent, possessing assets that exceeded liabilities on paper, and still collapse within days if it could not fund itself in the short-term market. Solvency and liquidity are not the same thing. In a confidence crisis, liquidity is the only thing that matters. That is the precise mechanism at the center of Bear Stearns. The firm did not slowly deteriorate over years of visible mismanagement. It was destroyed by a structure, heavy reliance on short-term funding secured by assets whose value the market had stopped trusting. That was stable only as long as confidence held. When confidence broke, the structure could not support itself for even a long weekend. The empire was not brought down by its worst year. It was brought down by the specific way it had built its best years, and by what happened when the ground those years were built on shifted beneath it.